In 2020, the world witnessed a historic shift. We figured out how Zoom works.
That's right, America. It took several months of painstaking muted mics, unmuted mics. I didn't get the invites. Same time, no, you go ahead, and wildly missed jokes. But we as a nation, we pulled through. And now, with our cameras turned on, our check me out, I'm in space, virtual backgrounds, many of us find ourselves looking out our windows, wondering if we should take our talents elsewhere. Elsewhere being a state with no state income tax.
While there are a number of benefits to living in a no income tax state, some that you haven't even probably thought of already, there are a number of considerations as well, and we tend to think about those even less. So today we will discuss both. We'll dive into the top 10 benefits that I see, but we'll also talk about their corresponding considerations. But unfortunately, calculating the net impact of this decision is a fairly difficult computation. It's far from straightforward. So rather than just give you benefits and considerations, I want to walk through some examples with you as well. Give you some insight really as to how a full service planning firm like Mariner Wealth Advisors, where I work, walks through the different questions we get around this subject. Questions like, how much will I save in income taxes over the course of my life moving to a no income tax state? How much will I save in capital gains taxes moving to a no income tax state? How much will I save in retirement income taxes moving to a no income tax state? How much will I save in Medicare premiums if I go to a no income tax state? How much might I save in Social Security taxes moving to a no income tax state? And the list goes on, but if you've been thinking these questions or wondering them, you are not alone. My name is Michael McKelvey, and I'm a certified financial planner with Mariner Wealth Advisors. This is obviously a difficult problem. So at any point in time, if you'd like to get help with this difficult problem, you can click the link in the description or down below here to schedule a complimentary consultation with one of our advisors. We've been a Barron's top 5 nationally recognized RIA for the previous 6 years now, and as a part of our fiduciary standard, we are legally obligated to act in the best interests of any of the clients that we serve. If you'd like to continue getting content like this from industry professionals, I'd recommend also hitting the subscribe button to follow along for more of our videos. But for now, let's jump into it. The largest and likely most obvious benefit here, no state income taxes while you are working. However, it's often difficult to calculate how big of a benefit this is and consequently whether it's worth the move. Reason being, there are other higher taxes that a no income tax state will implement because they have to compensate for the fact that they don't have an income tax. So depending on your spending habits, depending on your real estate holdings, depending on your general overall plan, evaluating the cost benefit from an income tax standpoint, there's an opportunity cost on the other side you got to calculate as well, which makes it difficult. And additionally, and this is true for all the benefits we'll go through because none of the benefits will apply if you don't do this, you have to establish a defendable domicile. And that involves as much establishing the domicile in the new state, proving that you're in this new state and this is your permanent residence, but also severing your previous domicile with your previous state. Why is this important? Well, if you don't do this, that previous state might say, yeah, we want to check the legitimacy of your move. And they'll do that in the form of a residency audit, a highly invasive process that involves determining, again, did you actually move or did you just move on paper? And if they determine that you didn't actually move under their definition, the IRS will then probably go back and say, you owe us some income taxes for the time you're actually domiciled under this income tax state. You owe us maybe some capital gains taxes, potentially some interest, and obviously you don't want to do that. So this is very important for all of the benefits we'll go through. And thus, like many different things, you take a few more steps in and you find complexity. You might be able to determine how much you have in income tax savings by moving to a no income tax state, but there are other pieces, there are other variables. So here's how we handle it. So first, we always start with someone's current financial position as well as their projected financial position because it's important to not just know where you're at, but also where you're looking to go. And that way, when we're building out the models, we have a much more accurate reading. And our software will integrate all 50 states' taxation. So depending on where you move, we will obviously adjust the model subjective to that state when we're projecting these pieces out. Now, if you're attempting to do this longhand, keep in mind that this is a question of opportunity cost. It's not just the tax savings that you incur by moving to a no income tax state. It's where can those savings be redeployed and what would that grow to for you down the road, right? So it's a question of opportunity cost. And it's almost like a lot of things where the solution creates a few more questions, which will require newfound solutions. All of this is obviously highly subjective to your own individual situation. And from here, advisors like myself at Mariner Wealth Advisors, we like to typically call or lean on our in-house CPA team because one of the benefits of being a national firm, we can find a CPA that corresponds with the state that maybe the client is considering as well as the state that they're moving from. And then we can get the state-specific steps to establish that domicile while also severing the previous domicile in this case. And I think a lot of clients end up using our tax preparation services really as a result of just wanting an integrated, simple approach rather than wanting to work with, in this case, two different professionals. You could just work with Mariner Wealth Advisors and it could be under one roof, right? But even if you aren't working with us in any capacity, even if you aren't working with us at all, right? I still recommend talking to a tax professional because your situation is obviously so subjective. Your income sources, where you work, your potential capital gain liability, the domicile change piece, right? All of that is very specific to your own situation. So I definitely recommend talking to a tax professional. And on that note, I think it's worth noting that this is not a black and white piece, which means you'll find varying opinions from different CPAs on it. They'll have different beliefs, they'll have different thoughts around what constitutes, a capital gain sale in this state versus this state. And that's a result of this just being kind of a gray matter. So I recommend talking to a few different professionals on that note. Now, the tax savings don't just end when you stop working, because your distributions from retirement accounts, your distributions from some pension, which there's fewer of those, you wouldn't have to pay state income taxes on the payout if you lived in a no income tax state. But knowing if, and in this case, how much that benefit is, can be a challenging computation because it's going to greatly depend on your spending habits as well as where you're going to be taking the money from. And additionally, the question of what are you doing prior to retirement? Because retirement is not just something you get to and say, all right, now I'm ready to change everything. There are gradual changes along the way. So there might be unique strategies that make sense if you currently live in a no income tax state prior to retirement that you can take advantage of. There might be unique strategies that exist if you have an early retirement, prior to normal Social Security retirement age. There's a number of different pieces and variables to this. And it's greatly dependent on, again, where you're living as well as where you're planning on living. So we always like to model this out just so we can get an accurate reading on the opportunity cost for somebody. So many people have deferred a significant chunk of their income to traditional retirement accounts, traditional 401ks, traditional 403bs, traditional IRAs. And while that has a benefit, especially if you're in a high income earning year in comparison to retirement, let's say, what does that mean? You have an impending tax liability. You're lacking something. And that something is diversification, but not the traditional diversification. Tax diversification. Tax diversification through Roth monies. And this presents a few challenges. Number one, if tax rates go up, we're in a historically low tax environment. So if for whatever reason our government gets together and says, yeah, we should probably start chipping away at that deficit, one of the ways might be raising taxes. So if you've just deferred all this income your whole life, you might have to pay more tax as a result of higher tax rates. And number two, required minimum distributions. At some point, you will be required to take monies from your traditional accounts. You don't have to do that with Roth monies. There are no required minimum distributions. And number three, if your income is just higher later in life as a result of all these different income sources, such as Social Security, which isn't present earlier. And I know people joke and laugh about Social Security, but it is a decent amount of income that you'll have to take later in life if you've been paying into the system. You could just be in a higher tax rate. So you might be paying more tax as a result of just making more money in retirement than you would have if you just would have paid those taxes earlier. So if you move to a state with no income tax, you don't have to pay state income taxes on Roth conversions, potentially saving you huge dollars if you implemented the strategy effectively. So it works in a relatively straightforward manner. You can take any amount of your traditional IRA and convert that into a Roth IRA. Okay, so sometimes there's a misunderstanding here that you have to convert your entire traditional account to your Roth IRA. That's not the case. But often where I like to consider this is in what I refer to as a gap period. So if you have an early retirement, if you have a sabbatical, if for whatever reason your income is otherwise lower than it normally would be, these are all great opportunities to consider a Roth conversion. And of course, if you're converting that in a state where you don't have any income taxes, you don't have to pay any income taxes on that conversion. But I always like to model this out. We always will model this out at Mariner Wealth Advisors because we want to bring, again, a quantitative measure to an otherwise qualitative thought rather than just giving generic advice. Backdoor Roth IRA. I think backdoor kind of has some negative connotations with it. It sounds shady, but it's completely legal when executed correctly in this sense. And it's one of the more effective strategies for high income earners. Here's how it works. You contribute monies to a traditional IRA, and even though you might not get a deduction for that, you then take those monies and convert them over to a Roth IRA. And if you're in a state that doesn't have state income taxes, well, you don't have to pay state income taxes. So you'd pay less taxes than a state that you would have income taxes. Now, the backdoor Roth IRA was up for elimination with the Build Back Better Act, but for the time being, it looks like it's here to stay. So if you plan on pursuing this strategy, there's a couple different factors I would pay attention to, and they're relatively similar to the ones we discussed for other strategies. Number one being, is my tax rate going to be higher in the future than it is today? Another big one might be, will the country's tax rates be higher today or in the future? And I recognize you might not know that, but if you don't have much tax diversification, it might be worth considering this a little bit more to build up more Roth monies. And I would say a few other just considerations on this. When do you plan on withdrawing the money? There are some rules around that with the backdoor Roth IRA and Roth IRAs in general as far as how long the money might need to sit there. And lastly, how does this factor into my current tax and just retirement plan? As always, we will model this out for somebody just like any of the other pieces to figure out, is this a strategy worth pursuing? Now, a typical argument from someone living in a high income tax state is, we don't have any sales taxes, or we have very low sales taxes. Unless you live in California or New York, where you kind of have both. But one massively overlooked advantage of no income tax states is the capital gains tax savings. So states that don't have income taxes also don't have capital gains taxes at the state level. Now that might be wildly important for an employee who's equity based and has a bunch of employer stock, or just anybody with a taxable portfolio. So for example, if you lived in Portland, Oregon, and you looked across the water to the Columbia River, the mighty Columbia River, and you said, there's Vancouver, and across there in Vancouver, if I can just swim there and I can domicile there in the state of Washington, and I sell my stock after domiciling correctly in the state of Washington, I would save 10% on my taxable gain. It's big savings if you have a large taxable gain. But perhaps, the bigger challenge here in question is just, when should I realize a capital gain? I've seen investors chase tax plays, ditching the fundamentals of good investing for pursuit of a few $100s of tax savings. And I especially see equity-based individuals struggle with this, but people, with just traditional tax portfolios that have, a low basis and, let's say a large gain, they can really gain a sense of paralysis where they just are unsure how to best unwind those positions. And, the sayings that will float around when this is occurring, right, are in various forms, but they all kind of carry the same underlying meaning. We're at 65. I'm going to wait until we get back to 65 because we were at 65 a month ago. Well, our earnings report came out recently. We looked pretty good there. I work for the company and I feel pretty good about where we're headed, right? We all seem to view ourselves as the exception to emotional investing. But we all struggle with this paralysis, these little voices that float around in our heads. And a capital gain, that's something that you have to deal with likely at some point, unless you just wait until you die. So while you may save taxes by waiting to realize the gain until you actually move to this new state, the belief that the stock will just grow in the waiting period is a false pretense. So this question of, well, what do I do with this large capital gain? That's highly subjective to one's personal situation. So when we get faced with that question, we take similar measures as a lot of the different pieces I mentioned before. So run out the scenarios and obviously consider the solution in accordance to each person's unique plan. And that means balancing risk management with tax plays. But rather than just give you generic advice, I'll leave you one piece with this from my experience working with this with a lot of individuals. We tend to look at each decision as this or that, when maybe the far more appropriate answer is what combination of strategies and risk management makes the most sense. How does it all come together in the most efficient way? Similar rhetoric here. Everybody seems to focus on income and sales taxes, but many people, they're growing their wealth through their business or some business venture. And at some point in time, a lot of people, they want to transition that business to somebody else in the form of a sale. If you do that in a state with no income taxes, you don't have to pay state income taxes. Now, this is far from cut and dry. There's a lot that goes into this. Where is your business located? Where is your customer base? Where are you located, right? There's a number of different factors. It's not just, hey, I lived and domiciled in Washington, so I don't have to pay capital gains taxes on my business now that I sold it. There's a number of different factors that go into this, and many different states could claim you from a capital gains standpoint. So we consult a ton of business owners on this regularly. I definitely would vet this with some professional. Corporations. We don't think of a lot of good things when we hear that word. We think behemoths, we think the Amazons, the Googles, the Walmarts, right? But the reality is there are over 2 million corporations here in the United States. C corporations, that is. And corporate taxation can be a little confusing, but there are some states that don't charge corporate income tax. Now, what that means is if you own a C corporation, you maybe have some tax advantages. And if you're an employee of one, they might have a little bit more money to pay you. You might potentially get paid more. Potentially on that last one. But, there are city and local taxes from a corporate standpoint that come into play here in addition to the state and federal, obviously. So this is highly subjective to wherever the business is, but still, this is potentially a benefit for someone. In addition to no long-term capital gains taxes, residents of no income tax states, they don't have to pay short-term capital gains at the state level. So normally, when you have a stock and you hold that stock for less than a year and you sell that stock at a gain, you have to pay short-term capital gains, which is ordinary income tax rates. And you have to pay that at the federal and state level. But if you live in a state that doesn't have a state or capital gains tax, you don't have to pay that tax. So that's a big benefit for anyone that's experiencing short-term gains at a relatively large clip. Bond income would also normally be taxed at short-term rates. Non-qualified dividends would also be taxed at short-term rates. Any asset that you held for less than a year, right? There's a number of different benefits there. But long-term capital gains tax savings, they tend to get all the love in this case. But short-term is another big benefit here as well, and certainly something worth considering. Social Security taxes, they're interesting. So they're determined by what's called provisional income, which is an IRS measurement that will take into account a number of different factors. Your Social Security benefit will actually count towards it. So part of that will count towards it, but then other pieces will count towards it as well. So retirement distributions, traditional ones will count towards it. Other forms of income will count towards this provisional income. Oddly, Roth distributions don't count towards it, which is a huge benefit of Roth that often doesn't get talked about, is the fact that that doesn't trigger any Social Security taxation when you take from Roth monies. But there aren't really any workarounds to drive down this provisional income, loopholes of sorts. But if you didn't have to take as much money from your retirement accounts because you didn't have a state income tax, you potentially wouldn't need to trigger as much Social Security taxes, right? So if you had to take, let's say, 10% less out of your retirement accounts or 5% less out of your retirement accounts because you don't need as much money because you don't have to pay that in the form of taxes at the state level, you're not paying maybe as much in Social Security taxes because your provisional income comes down a little bit. And it's a fairly complex calculation, and I won't dive too much into it, but there is that potential benefit. So many pre-retirees are unfamiliar with how Medicare premiums work, probably because they have a life and they're not waking up on Saturday saying, I want to learn about Medicare, but it's also primarily because they just haven't dealt with it yet, right? But Medicare is not the most exciting thing in the world. But Medicare has these different components. Let's talk about it real quick. It has Part A, and that's largely free. Now, Part B, that's optional. People come out of the woodwork and say, it's optional. I don't got to pay for it, right? I don't got to do it. Well, the penalties get pretty stiff if you continue to delay enrolling it and you just choose not to enroll in it. So eventually, you probably want to do it. And those premiums that you have to pay for it are going to be based upon your MAGI, your modified adjusted gross income. So they jump up quite a bit based on your income. And if you didn't have to take as much from your retirement accounts, which would affect MAGI in this case, you wouldn't have to pay as much in Medicare premiums, right? So if you had to take, let's say, 5-10% less because you didn't have a state income tax, maybe you don't have to pay as much in your Medicare premiums because your income would then come down. So another consideration, might not be a huge benefit, but something to think about. Moving is undoubtedly a difficult choice. It's personal, it's financial. There's a lot that goes into it. It's undeniably complex. So if you'd like to get help with that decision, you can feel free to click the link either in the description or down below to use our calendar tool and find a time for a complimentary consultation with one of our advisors. And at the very least, make sure to hit that subscribe button to follow along for more content from industry professionals at Mariner Wealth Advisors. Take care.